All right, again, students, welcome to this lecture. We are going to cover Chapter 2, Financial Statements, Cash Flow, and Taxes. So if you recall from my very first lecture, Session 1, when I was discussing about the premise of this course and the importance of this class, what is it about businesses which is very important in terms of financial planning and financial analysis? I think we had discussed about cash flow. Cash flow, small or big, all businesses have to really manage the cash flow really closely. Otherwise, what can happen if there's a mismanagement of cash flow, or if you overlook certain things such as notes payable or accounts payable, then your suppliers can possibly take you to court, and force you to file bankruptcy. I've seen so many, good businesses go that route just because they couldn't really, manage the cash flow very well. So this chapter, even though we're going to cover financial statements, cash flow, and taxes, really this chapter is more about, understanding the value of cash flow. Obviously, you have to understand how to read the financial statements, and the fact that you are in this course, I'm assuming that you know how to read the financial statements. I'll quickly go over the basics of the three most important financial statements. Which are the three most important financial statements? The income statement, the balance sheet, and the statement of cash flows. Those are the three important statements, and I'm quite happy that students in class have responded straight away. So I hope students online, you will follow the lecture really closely, because this is the basis of what we'll cover for the rest of the semester. So the topics we'll cover in this chapter is we'll quickly review the income statement, balance sheet, the statement of cash flows, and then we'll talk about the free cash flow, the market value added and the economic value added to a company, the corporate taxes and personal taxes, because remember, the sole proprietorship and simple partnership are taxed at personal tax rate, whereas the corporations are taxed at corporate tax rate. So we'll look at some of the examples for both. So again, we come to this very basis of this entire class. We'll be talking about the valuation, and in this valuation formula, we are looking at the determinants of intrinsic value, calculating the free cash flow. Why are free cash flows so important, I ask again, to a business? And what else? What else does free cash flow provide to a business? Those are the sources for actual net income that can be distributed with the shareholders. Remember, we talked about the free cash flow, the free and clear money available as income, which can be distributed with the shareholders, and that is really going to bring out the true increase in the market value of a company. Why is Google valued at what it is today, or why is Apple as a company valued at what it is today? Is look at these free cash flows. This formula, what does this FCF1 stand for in this formula? The free cash flow the first year, and what about number 2, the second year? Is it historic, or is it to happen? It's to happen, because free cash flow 0 would be today. So this is actually anticipated. This is what we're anticipating, and it goes on to infinity, and it's discounted by 1 plus weighted average cost of capital. So basically it's saying the cost of capital that the business had to incur to finance the projects or the operations of the business, it is discounted by that cost. So what would be the free cash flow discounted by this weighted average cost of capital? That will be the value of the company, because you're adding all these future cash flows. And what would this value be? It essentially is the stock price of the company in the market today. That is how the stock price of a company is assessed by, analysts. From today onwards, what has happened is happened. Stock price is not based on what's happened. It's only from today onwards. So the present value of the stock, the present value of the company, which is the stock price of the company, is solely based on the anticipated future cash flows divided by the cost of capital. They have various formulation, but normally they'll go ahead, 3 years or 5 years ahead, and they look at things like current factory orders. How much of orders are available to the company, because that's public information. When companies report, they will report how many orders they've received, where they're spending money. For example, if they're building any factory in China or some other place, that is going to be an indication to the analysts who will sort of make a guess that this is probably going to be the number of units the company will sell. And they will also try to estimate what is the profit margin they keep on each unit, and then look at the various expenses the company occurs, and thereby coming with an estimate of what the net income would be in times to come. Yeah. That is a very good question. That actually will come down here. It will be discounted by this weighted average cost of capital, or the risk. So if the device is not popular, the risk factor will go up. If the device is very popular, the risk factor comes down, because look at the relationship between value, the denominator, and the numerator. If the denominator goes up, what happens to the value? It goes down because it's inverse relation. So that's a very good question, because as the risk to future cash flows go up, the value will come down. So things like China slowing down, obviously it will have an impact on Apple's profitability, because if, let's say, 30% of Apple sales come from China, and if China is slowing down, analysts will start putting in the formula. So it's as much a science as an art. So you might say, well, it may slow down to 25%. I may think it will come down to 20%. Robert might say it's 23%. So we may be guessing as much as looking at it as a science, looking at the numbers of actual units they sold in the past and what the historically incremental increases have been. So for example, if China has increased sales by 10% each year, I would have added 10% for next year, but I'm going to discount now by 25% because China slowed down. So my discount factor will go up. So this is how that formulas will come up. There is no one formula to come up with the R factor. That's why are some investment analysts more successful than the others? Warren Buffett has made billions of dollars. Why is that? Because he has some way of estimating that risk factor, and thereby sort of analyzing which companies he should invest in, which are more economically lucrative companies right now. And he has a very simple formula which we'll cover when we come towards the end of the class today. So students online, are you clear with this discussion? And you can see that in this case, the weighted average cost of capital is the cost of debt plus the cost of equity. So let's look at this simple scenario. I'll just quickly go over what this statement actually refers to. For those of you who haven't looked at an income statement for some time, it'll be a quick refresher. So what we have here is an example taking income statement for 2 years. One is for 2009 and 2010 for any company. It's just an example. You always start with sales. You know, so in 2009, this company had a sale number of close to about $3.4 million, and then in 2010 about 5.8 million. Cost of goods sold are associated costs, the costs associated with the sales of the goods that generated these revenue. By the GAAP principle, you can only take associated costs. So for example, if I report, this sales revenue coming from 1,000 units, I cannot take costs of 10,000 units. I have to report costs associated with the sales of those 1,000 units only. That's why it's a matching principle. So this cost of goods sold are associated with these sales. So the sales is roughly the cost is roughly 2.8 million in 2009. In 2010, it's 4.9 million. So you can see that whereas the sales has increased, the costs of goods sold have also increased. Does everyone agree? Other expenses can be, other associated expenses, which have also increased from 340,000 to 720,000. Depreciation is the cost that the company claims for wear and tear of various fixed assets, and that has gone up from 18,900 to 116,960. But what is such an interesting thing about depreciation? What is such an interesting thing about depreciation as an itemized number? Even though it's an expense, the company doesn't pay anyone. It basically is a claim back. So companies actually claiming this fund, even though it's reported as an expense. That's, yes, all fixed assets. Yes. So this is basically saying the company used the machine or transportation or vehicles that it has to get this sales revenue, and it's claiming this as an expense. So the interesting fact about depreciation is, even though it's an expense, the company actually doesn't pay anyone. Actually, it claims this money to replenish the machine. So if it's like a straight line depreciation, 10% depreciation every year, the company probably is going to replace the machine in 10 years. So it has to claim back the funds coming from this expense. So the total operating costs are, if you add all these operating expenses less the sales, would be 322,900. And in this case, the total operating cost would be, so if you add these three line items, it'll be 5,816,960. So sales minus total operating cost gives you EBIT. What is EBIT? Earnings before interest and taxes, and it's a very important line item. If you are investing in companies, this is something that you look at very carefully. It's sometimes also referred to as EBIT. Earnings before interest and taxes. So what has happened to EBIT between 9 and 10? It's gone down dramatically, from 209,000 to 17,440. It's straight away an indication that the company is probably not going to make as much revenue, as much profit as it did the previous year. Interest expense is what? It's the expense that the company has to pay for, the long-term debt or any debt that the company has incurred. And it has increased from 62,500 to 176. What is that an indication of? Borrowing more money, very good. So this is clearly an indication that the company may have borrowed heavily, because the interest expense has gone, almost, I would say 3/4, from 62,000 to 176. So EBIT less interest expenses, earnings before taxes, and not a good number in 2010 because it's already a loss, 158,560 in 2010. Taxes 40%. So company paid 58,640 in 2009, but it actually claimed a chargeback in 2010. Why is company getting a credit here instead of paying taxes in 2010? It's because of the loss. Company cannot pay tax on a loss. It actually will receive a credit for that. So it's getting a 40% credit on it, which is 63,424. The net income in this case is 87,960 in 2009, and in 2010 it's 95,136 negative, which is a loss. Okay, everyone clear on the income statement? Okay, let's move on. So we have already discussed what happened to sales and net income. Sales increased by over 2.4 million, which is this number here. However, cost also shot up by more than sales. I mean, why do you think cost shot up? Maybe the company invested in new showroom, or maybe they redid the way their outlets look, or how they're displayed, or maybe they went heavily on buying new products to display. So companies do that to attract customers. Net income was negative. So do you think, I mean, in a practical scenario, net income being negative in this scenario is a worry, is a sign of worry, or is it? But that is something, also 1 year shouldn't really bother you as much. Sometimes companies to revamp may take a loss because they may just be realigning their products for something new. Exactly, they look at long term. Yes. So they have a 5-year or 10-year strategic plan, so they may have a plan to rehaul the company, and they may be investing right now to just change the products like Apple did. Apple was almost at bankruptcy in 2000. I remember 1999. Apple was almost was going to be bankrupt, and then Steve Jobs came and he overhauled the company. Obviously, it took money to change the product line again. Introduce new products in the market and have products in the pipeline, and that took those 2-3 years for a negative kind of a cash flow, and then the company obviously came back in the market. So even though on paper, yes, I would, as an investor, I would feel stressed out, thinking, hey, this year is not a good sign. But if I'm a patient investor, and if I have faith in the management of the company, I may give them some time to sort of look at their product lineup and see if they're just trying to change things. So let's look at but this is a discussion. I'm not saying that this is the only point of view. I mean, Robert, you're right. You may think as an investor that, hey, this is time for me to get out of the company. But maybe I would think, well, I'll just wait for another year and see how it goes. So investors think differently. That's why we have a market. Yes. Yeah. So, like I said, however, the firm received a tax refund since it paid taxes of more than 63,424 during the past 2 years. So this is like a claim back because of the loss that the company made. Let's look at the balance sheet. Before we get into the discussion of balance sheet, what is the balance sheet identity? What is the basic formula for balance sheet, if you all remember? It is, but left-hand side equals the right-hand side. So what's on the left-hand side? Assets. And what is on the right-hand side? Liabilities plus shareholder equity or owner's equity. Different textbooks have different ways of expressing that. Students online, do you all agree with that? So remember this basic formula. Assets are equal to liabilities plus shareholder equity. Again, we're looking at a comparison of 2 years, so 2009 compared to 2010. And how are the items organized in balance sheet reporting? What is the order of these items? What is that technical term called? What is that called? Or what does that refer to? We covered in liquidity, yes. We covered in the very first session liquidity. They're ordered in the order of liquidity. How liquid they are reported first. How illiquid they are reported the last. Why? Because cash is most liquid. Cash can be converted into cash without any loss in value. Short-term investments are, liquid, but it may take some time to convert that into cash. Accounts receivable, inventories, and the most illiquid is fixed asset buildings. Buildings can't be sold within instantaneously. It takes time to sell or dispose of buildings. Students online, do you all agree with that? All right, so let's cover this. Company had $9,000 cash in 2009, and it went down to 7,282. Short-term investments again are, if you can call short-term would be anything which is less than 1 year. So it went down by about 28,600 in 2010 from 9. What are accounts receivables? Yes, the products or services that the company has sold but has yet to receive payment, or the payment may be in transit. Companies or businesses normally give their clients some credit, credit facility to incentivize sales. Like car manufacturers might give dealers 90-day credit to, sell a car. So this is goods and services which have been sold, but cash has not been received. So you can see that it has increased dramatically, accounts receivable. So the marketing team of this company may be very aggressive. They may be trying to provide very flexible credit facility, maybe from 1 month to 2 months. So that has, that this is the increase. Inventory are goods which are lying in the warehouse of the company, which are yet to be sold. Again, it's gone up from $715,000 to $1.2 million approximately. Is that a good sign or a bad sign? Inventory increasing. It's normally not considered good, because you don't want to be having too much of inventory which is not moving in the market. What can that result in? Product, yeah, they could go out of favor if it's like an electronic, sort of industry where products change every 2 or 3 months. New models come. It may not be as a good thing. So it's probably is not such a good thing to have such a big inventory lineup. Again, it's money tied to this inventory. Company is now going out of the cash that it could have used for other operations and things. So think of it also as cash which has been tied up in goods which have not been sold. What do companies do in the end, year end, if they can't sell them? They'll have to have sale or clearance. That's giving discount or selling at a loss. Year-end car models are sold off at huge discounts. Why? Because those are inventory which probably will not sell next year. So the total current assets are 1.124 million in 2009 and 1.946 approximately in 2010. So even though, you might think total current assets are a good thing and the sign that it's gone up, looking closely, you can see that they're tied up, majority of it's tied up in accounts receivable and inventory, which may not be a good thing after all. Do you all agree with that, students online? Quincy, you're right there. You've said the right thing. So that's good. We all agree with that. Gross fixed asset. Now, what are fixed assets? Fixed assets are assets which have a term life of over 1 year. So buildings, plant, machinery, you mentioned about vehicles that the company may own. The company is going to be using them for over 1 year. And that has increased from about $500,000 to $1.2 million in 2010. So the company is expanding. They're investing heavily into, setting up new plant or maybe sales office or whatever physical fixed assets that they're buying. They've increased by threefolds. Less depreciation. We've already discussed about it. The chargeback that the company takes to replenish these fixed assets because of wear and tear. So the net fixed assets in 2009 were 344,000, and in 2010 now are almost 3 times, 939. So total assets were 1.4 million in 2009, and in 2010 it's 2.8 million. I mean, just discussing what companies are doing. What do you normally see happening as a trend in terms of fixed assets with companies today, generally? As a trend, what are companies doing with their fixed assets? Plant, machinery. They're not really adding to fixed assets. They're just concentrating more on services, design, sales, marketing, finance. They would have a third-party manufacturer for them, somewhere in China or wherever. So what are companies doing? They are reducing their fixed asset. So by reducing the fixed asset, what happens? The company frees up cash for other operations, sales, maybe providing good credit facility, or maybe hiring design engineers or advanced, paying good salaries to get competitive engineers from the market to come up with new products which will sell. And they are focusing more on research, design, sales, marketing, leaving manufacturing to third parties and writing that as an expense. So if let's say, for example, a company in China manufactures iPhone for Apple, where does that expense come? Where would that expense be reported? Exactly, that will be cost of goods sold. So the cost of goods sold will go up, but the fixed asset cost will come down. Is it good or bad? That's for, I'll leave it as a case study for, you guys to discuss or sort of think about. But I was just going to let you know about, what the trend has been. So we have some comments from students online. We got Quincy mentioned that it's good in long term. It definitely has helped a lot of companies. Look at Apple. Apple, it's helped because Apple has shifted away from its own in-house manufacturing and concentrated on doing things which it's good at. Apple is inherently good at what? Design, research, coming up with new products. They know marketing. I mean, they know how to sell their products, and they definitely know how to have their products have a market share. So they have moved away from manufacturing and invested the money into all these areas of operation. So effects of expansion on assets, net fixed asset almost tripled. We've observed that. Accounts receivable and inventory almost doubled. Cash and short-term investments fall. We all observed that. So now on the right-hand side are the liabilities and equity. So what is one thing about balance sheet is left-hand side should match right-hand side. They have to be equal. So obviously the final numbers have to match, for both years, which we have seen. Again, liabilities start with the, order of liquidity. Accounts payable. What are accounts payable? Quincy, you have the right answer, but it's not loans. I wouldn't call them loans. It's what you have to pay to your vendors. So like the vendors have given you credit, and that has to be paid, for all the raw material and supplies. So that has increased from 145 to 324. So the vendors are also giving company, some extra credit facility. So that has increased. Is it a good thing or a bad thing for a company to have a, increase in accounts payable? Cash flow wise. Cash flow wise would be a good thing because the company doesn't have to finance this gap. It's free money that the suppliers are sort of financing the company with, but obviously the company has to pay at some time. Notes payable are short-term loans that the company has to incur to cover short-term funding requirements, and that has increased from 200,000 to 720. Obviously the company would have to pay some interest on, notes payable. Accruals are, like insurance or other, lease payment and other things which the company has to pay yearly, and that has also increased from 136 to 284,960. So the total current liabilities are 481 in 2009, and they've increased to 1.3 million approximately in 2010. That's almost 3 times, again, consistent with how it's increased for the asset side. Long-term debt. So these two are the components for, financing. Long-term debt and common stock, debt and equity. It seems the company has taken the debt route to raise funds. You all observe that? Students online? Almost 3 times, from 300,000 approximately to 1 million in 2010. Common stock are the same. It does not raise funds through common stock, so the company has not gone the equity route to raise funds. Why would the company do that? Why would the company not go through the equity route to raise funds, long-term funds or capital? Why the debt route? What could be possibly the scenario? These are loans. So we have an answer. The market interest rates would be favorable. When shareholders are brought on board, they are looking for a return on the investment through dividends, and they're expecting a certain return on investment. Maybe shareholders are looking for at least a dividend yield of 3 or 4%, and the company is able to raise funds maybe at 1 or 2%. Given what happened in 2008, they may be getting cheaper loan. So Quincy, again, you have the right answer. So students online, other students also have to participate. I see that the Quincy is answering all the questions. So total equity, retained earnings are 203,000 in 2009, and 2010 they are 97,000. What are retained earnings? Yes, money left over after all obligations that the company is retained for its ongoing operations. The company will not make profits every year. There may be years when the company may have to carry on, for their day-to-day operations, and they may have to pull from these savings. These are like savings which the company has kept for those rainy day fund. And companies had to do that right after 2008. All the companies were almost, basically they lost market share. They were not doing so well. The markets were not responding to sales as much. So companies had to go on for next several years on their retained earnings. Apple, by the way, has over 200 billion in retained earnings. Microsoft has another, 150 billion. Intel has 150 billion, close to that. So why is that money kept? Because of all these, rainy day funds, or when companies buy other companies. Right now, the market is cheap to buy other companies. So Apple, even if you don't know, Apple is buying smaller companies. All the new features that come on Apple, every time they come up with a new version of the phone, is by buying a small company. Last time they came with a thumb impression, like a scanner which will scan and have this. That was actually a company which Apple bought. And yes, and that it was not a technology that Apple had invented. They bought a company, so they were able to put on their device immediately. Yes, yes. They just went ahead and bought the company because it was cheaper. Again, they're looking at a simple formula. Is it cheaper to buy the company outright or to invent any new technology in-house? Because the product is patented. If Apple uses that on their phone, for every time they use it, they'll have to pay a royalty. Microsoft recently just outright bought which company? Nokia, because they wanted to get into the mobile market, by having their software, because it was losing market share. So they wanted to buy a company which could expand their mobile market share. So these are strategic, decisions that companies use. But where the money is going to come from? It's going to come from retained earnings. So total equity, this is something of importance to shareholders. That is, after all obligations have been paid out, what is their own equity? And it's decreased from 2009 to 2010, and that's not going to make shareholders very happy. It's going to become really difficult for management of this company to explain why the equity share has decreased. And that's why, like we discussed about Dell last week, why did Dell go private? It's essentially for this reason, because Dell didn't want to explain to its shareholders why they're expanding or making those expenses, and because every time shareholders would demand an explanation why you're making, you're spending so much money in expenses. So this way, if the company has a long-term plan, they won't have to explain that your shareholder equity has gone down, but hey, hang on, wait, give another 2 or 3 years, and we'll show you a new company. But sometimes shareholders don't have that kind of patience, because shareholders want to buy, and these days shareholders are becoming very they want to invest and just sell immediately for short-term profits. Okay, students online, did you all get that? Everybody clear with it? All right. So what effect did expansion have on liabilities and equity? Current liability increased as creditors and suppliers financed, and we had discussed this part of the expansion. Where is that? It's coming from this part here, accounts payable and notes payable. That has increased and that is financed. Long-term debt increased to help finance the expansion of the company. The company didn't use any stock, Retained earnings fell due to years negative net income and dividend payment. The company still went ahead and paid dividend. Why is that? To keep shareholders happy, otherwise shareholders get upset. Exactly, Quincy, the shareholders need to be kept happy. And think of it like the political system. What happens if your representative doesn't keep you happy? Next time there's voting, he or she gets voted out, right? So same thing with the board of the company. Shareholders, when they vote, if they're not happy, they'll vote the board out. And when the board is replaced, obviously the management of the company is also going to be fired, because when the new board comes, they'll come with a new management. So let's look at the statement of cash flow. And the statement of cash flow essentially comes from, three parts. One is, it's not clearly mentioned here, but operating activities are part, you can call it A. If you have a PowerPoint, you can just write A here. And you start with net income, and we're referring to 2010, so we can look at the net income of 2010, which was negative 95,136, and then the adjustments. Depreciation for 2010, where is depreciation going to come from? You can look at balance sheet, and this is kept as a positive number. Why? Why is depreciation kept as a positive number? And statement of cash flow has a very simple formula. Anything related to money coming in will be positive. Anything going out will be negative. This is a simple formula for treating all the adjustments. So again, why is depreciation a positive number here? It's a charge back. Remember, I explained, even though it's an expense, the company is not paying expense to anyone. It basically is taking a charge back. So this is adding to the company's cash flow situation. So exactly, Deborah, you're right. It's a non-cash expense, so it actually is increasing the company's cash flow. So this is kept as a positive here. Change in accounts receivable. So the way you will look at would be look at 2009. I'll show you one example. So there you go. This is 2009, and this is 2010. So 632,160. Does anyone have a calculator? I can open one on the laptop, but that'll, break the Blackboard display page. So give me the answer for 632,160 minus 351,200. 280,960. Okay. So is this money coming in or going out? It's out, right? Because this is accounts receivable. Your clients have yet to pay this money, right? So that increase has happened. In 2009, it was 351,200. It jumped from this number to this number. So think of it as this money has yet to come. So this is going to reduce your cash balance by that number. Does everyone agree with that? Do you all get it? So this is going to be negative 280,960, and that's why it's reported as a negative number here. Change in account receivable, negative 280,960. Change in inventory. If the inventories increase, what's going to happen to your cash flow? It's going to come down because you haven't realized money as yet. So again, going by the same logic, if you have a calculator, you can do 1,287,360 less 715,200. What's the number? It should be 572,160. Right? And that is decrease. Because you have increased inventory, that means less cash for you. And that's the negative here. Change in accounts payable. And this is going to act reverse. So now you don't have to pay that much extra money to your suppliers. This is going to help your cash position. And this is again going to come from this one here. Accounts payable from 145,600, it has increased to 324,000. So the addition is the amount that you don't have to pay right now. It's going to help your cash flow situation, and that is what's reported here as a positive. Everybody agree with that, online students? Change in accrual, 148,960. Again, and this is a little so accrual has gone from 136 to 284. Think of it as money you still have, like an escrow account, which will pay your insurance and other things. So this is increasing your cash situation. Okay, everyone clear with that? Right, escrow account. You still have to pay, but right now you have prepaid. You kind of have kept in your escrow account, which you will pay, let's say, whenever the insurance is due, maybe in November. But you already have this amount in your escrow account, which will add to your cash situation. You haven't paid actually. So this is the accrual, and you add all of it. The net cash provided used by operations is negative 503,936. So this is A. Depreciation will always be positive, yes. Change in accounts receivable will depend on situation. If your accounts receivables go down, then it'll be, it'll be positive. Accounts receivable. So for example, if it were 2,000 in 1 year, and in another year it's 1,000, so you have realized those $1,000 through the year. So that has increased your cash situation. So you have to look at the numbers. It's when you say statement cash flows, the operating activity minus $500,000. Correct? Repeat your question. When you just say statement cash flows, the operating activity is minus 503. Yes, for this example, yes. So this is A. Okay, let's go to B. So this is B, which is investing activity. Summarizing investing activities, that is use of cash flow from investing activity. Cash used to acquire fixed asset. Where would you get this information from? Balance sheet, right? So let's look at the balance sheet. Let me clear this. Okay, fixed asset here. So this is the item we're interested in. So the fixed assets have increased from 344,800 to 939,790. What is the difference in number? So can you give me the number, calculator? 939,790 less 344,800. It should be 711,950. Let me see. Just a minute. So it'll be 939,790. $594. Okay, my mistake. It should be it should be the gross fixed asset. That was my mistake. 1202,950 minus 491,000. That's equal to 711,950. Students online, my mistake. Let me clear this out. It was right here. I think it's been a long day for me. Gross fixed asset, this is the number you have to look at, this one. So 1,202,950 less 491,000, because this is related to the fixed asset. Okay, everyone clear? But the important thing to understand here is, how would that be reported in your statement of cash flow? Is it going to help your cash situation or lower your cash situation? Exactly, Quincy. It's going to decrease your cash situation because you're buying asset, so cash is going to flow out. That's going to be reported as a negative number, and that is exactly how it is reported here, which is negative. And we have the right answer. Change in the short-term investment. So company decided to sell $28,600 worth of short-term investments. So your net cash provided used by investment activity is negative 683,350. Okay, everyone clear? So let's move on to the third part, which is C, and this is cash flow, a statement of cash flow from financing activities. The first one is change in notes payable. So notes payable has a report of a positive 520,000. What would that indicate? It would indicate that the company has raised short-term funds, from the market. So let's go back to review that. Here, notes payable. So 720,000 less 200,000, that's 520,000, right? And that is positive because money is going to come to the company because the company has issued notes in the market, and that those notes will provide cash to the company, the short-term cash. So let's go back. So there is it. There it is, 520,000. Everyone clear with it? Okay, what about change in long-term debt? we see a positive number, 676,568. What would that be an indication of? We've already discussed the company has increased the long-term debt. So it's taken more debt from the market, and that again will come from the balance sheet. Here you go, long-term debt. So 1 million less, let me quickly, so it'll be 1 million less 323,432. That's equal to 676,568. And that is to be reported as a positive. So let's go back. There you go, 676,568. Company has taken debt from the market, so the money is going to come to the company. So it's like a loan the company has incurred. So obviously, when you incur a loan, you get or you receive cash. Payment of cash dividends. Company decided to pay $11,000 worth of dividends. So that's going to take money out from the company. That's reported as negative. So net cash provided used by financing activities is 1.8 million. Approximately 1.1 million 885,568. So summary of statement of cash flow, what you do is you add all the three parts, 1, A, B, and C. So we start with that. So the net cash provided used by operations is negative 503,936. Net cash to acquire fixed asset is negative 683,350, and then net cash provided used by financing activity is 1,085,568. So you add all three, and obviously since these are negative, you can add these two together and subtract it from 1,085,568. So the net cash in the year would be 1,780 negative. Cash at the beginning of the year is 9,000. Where is that going to come from? Exactly, Quincy, you are exactly right. It's going to come from the balance sheet. But you will take the 2009 number. Why is that? Exactly. When is the balance sheet usually created? At end of the year, 31st of December. So this 9,000 is carried over to 1st January for 2010. Everybody understood that? So that's why this is at the beginning of the year, 9,000. Students online? So that's the reason why you have this reported here, 9,000 cash at the beginning of the year. So simply 9,000 less 1,718 gives you 7,282, which is cash at end of the year. And interestingly enough, if you go back to see the balance sheet, this is the amount reported as cash at end of 2010, which will be cash at the beginning of 2011. So everything checks out. We know our balance sheet and the statement of cash flow are correct. Everyone clear? All right, so let's move on. So what can you conclude from statement of cash flows? I mean, if you have to discuss some of these items, the net cash flow from operations, which is negative about $500,000 because of negative net income and increase in working capital. The firm spent close to $711,950 on fixed asset. The firm borrowed heavily and sold some short-term investment to meet its cash requirement. And Quincy, you're exactly right on target in your reply, you're saying sounds like company borrowed money to satisfy investors, maybe to expand possible. So exactly, you're right that they borrowed heavily to invest, for these fixed asset increases and expenses. Even after borrowing, the cash account fell by $1,718, which had to be covered by the cash in hand. Otherwise, the company, couldn't have carried on because it was still short. So what is free cash flow and why it is important? As we had discussed, the free cash flow is the amount of cash available from operations for distribution to all investors, including stockholders and debt holders, after making the necessary investment to support operations. A company's value depends on the amount of free cash flow it can generate. We have discussed this, and we will cover in detail when we come to the chapter on the stock price. Then we will get to understand the formula as to how free cash flows are used to assess stock price of a company. So what are the 5 uses for free cash flow? How can these free cash flows be used? And the company can pay interest on debt, because company has to pay interest on the debt it's taken. The company can decide to pay back the principal on debt. Why would the company want to pay back principal on debt? Quincy, I think, yeah, that's an okay answer, but the complete answer which Quincy has provided is if the company can refinance at a lower interest. Why do we refinance our home mortgage? Is to take advantage of, a lower interest rate. And also, if the company has enough of cash, sometimes company would still keep the debt. Why is that? Because company may use the cash in hand for a better return on investment than the debt, the interest that the company is paying on debt. So for example, let's say for example I have $100,000 free and clear to invest, and I have currently a debt of, let's say, $50,000. What could I do with those $100,000? I mean, the first impression would be, why don't I pay off my debt? But if you have to follow, the principles of finance, you would look at what is my cost of debt. Let's say I'm paying 2% annual percentage return on this $50,000, and I have an opportunity to get a return of investment of 5% on $100,000. So would I still pay down my debt? No, because I could earn 5% here, and I have to finance my debt at 2%. So net, I would still be, netting 3% on the 50,000 and 5% on the rest of the 50,000. So in this case, I won't pay the debt. I will still keep, I'll still keep the debt because this is providing me with positive return. But sometimes, companies may decide to pay down debt to show to the market that they are not leveraged, they're in good position, and that will reflect in the stock price because the company is free and clear of any debt, and that may help the company's image. The company can pay dividends and keep shareholders happy. Company can buy back stock. What does buying back stock does to the company? We covered that in chapter 1. Even though it reduces the company's cash in hand, but it reduces the number of shareholders, right? And that means the company's overall market capitalization is divided amongst fewer shareholders. So let's say, for example, if there's a property worth $100,000, and originally there were 10 shareholders, and 5 of them decided to buy back 5 shares. So what has happened to their own equity? It has increased, right? Because each shareholder now has equity worth $20,000. Earlier it was $10,000. But it has, like it's not win-win situation. I mean, the company would have to reduce the cash flow situation to buy back those 5 shares. But sometimes it's a quick fix to help increase the share price of the company. Sometimes, company share price goes down for no reason, because market perception may be that the company is not coming out with new products, like Microsoft. Microsoft share price, if you look at over 5 or 6 years, you'll see that it's just like a flat line. So what can Microsoft do to increase the share price? Is to buy back its shares from its cash in hand, to reduce the number of shareholders but increase the equity price. And that may spike some investors to come in, because investors might say, hey, the price is going up, so let me just buy. And that may create that kind of a jump or start that the company may be looking for. So these are some of the strategies. Buy non-operating assets, for example, marketable securities, which may give them some return on investments in other companies, etc. So for example, let's say Apple may invest in Yahoo, Yahoo may invest in Apple. They all do that. Okay, students online, everybody clear with what's been discussed so far? Okay, let's take an example here of calculating free cash flow. And again, we'll go step by step. It says, 5 steps. So let's take one step at a time. The first one is to calculate the net operating profit after taxes. So how do you calculate net operating profit after taxes? NOPAT is equal to EBIT multiplied by 1 minus the tax rate. EBIT, if you're calculating NOPAT for 2010, EBIT would come from which statement? Income statement, right? So income statement, I'll just show you an example so that we don't have to go back and forth again and again. But I hope all of you will recall where these numbers will come from. So EBIT for 2010 is 17,440. For 2009 is 209,100. So NOPAT for 2010 would be 17,440 multiplied by 0.6, because 1 minus 0.4 is 0.6. And you can calculate on calculator. This is going to be 10,464. Similarly, for 2009, income statement had 209,100. So I can just demonstrate this example because it's not shown here. So it's 209,100 multiplied with 0.6, and that's 125,460. If you have calculator, students online, you can calculate this. Any questions here? It's quite simple, right? So next step, step 2 is calculating the net operating working capital. And this is going to be this So before that, it has a question asking, what are operating current assets? Operating current assets are current assets needed to support operations. Operating current assets include cash, inventory, and receivables. And operating current assets exclude short-term investments because these are not part of operations. Why do you think short-term investments won't be part of operations? They're not completely liquid, and they don't need, and like Quincy, you mentioned, they don't need to be they're not part of the operations of the business. They do provide some return on investment, but they're not essentially coming from the operations of the business. And then what are operating current liabilities? Operating current liabilities result as a normal part of operations. Operating current liabilities include accounts payable and accruals. Operating current liability exclude notes payable because this is a source of financing and not part of operations, because it doesn't come from the operations of the company, it comes from the market, so that's why it's not included in the operating current liabilities. So with this basic understanding, let's look at the example. I think the next would be the example for number 2, which is the net operating working capital that's equal to operating current assets minus operating current liabilities. So going by that formula for 2010, where would we get this information from? The cash, inventory, and receivables. Balance sheet on the asset side, right? So what all do we need to add? 7282, 632160, and the inventory, which is 1,287,360. We are not going to add short-term investment as we had discussed. Same thing for the liability side. For the operating current liabilities, let me clear this. For 2010, you will add accounts payable and accruals, but not notes payable, because this is a source of financing. It's not coming from the operations. It's just definition. If you just have to memorize, just memorize. Okay? So we have the numbers now, so let's go back to our calculation. But if you think logically, anything that's coming from the operations, that is to be added. Other will not. So 7282 plus 632160 plus 1,287,360 less 324 plus 284,960, and that's equal to 1,317,842 for 2010. What about 2009? Let's try to work 2009 since it's not given, it's not calculated. Again, operating current assets. You have a piece of paper, just write the numbers. I'll take you to the balance sheet again. So what's going to be added? 9,000 plus 351,200 plus 715,200 Okay, can anyone do the calculation? Robert, can you do that? So what's the number? Okay, write it on a piece of paper or so. Let's go to the operating current liabilities. So accounts payable in this case is 145,600 plus the accruals, which is 136,000. Students online, can you hear me? Okay, that's the number. That's the answer. So let me just. What was the number? 793, 800. So let's go back. There you go. 793, 800. That's how you got it. Okay, students online, any questions here? Just a suggestion for everyone, if you feel that you need to refer to the numbers, it'll be a good thing to keep a copy of the PowerPoint handy when you come to the class so that, you can follow the numbers. I didn't get as many responses, so let me. Well, it's not letting me share the Excel sheet. Otherwise, I would have shown it on Excel. But if you follow the process as we just did in class, go to. If you have a piece of paper and calculator, I can quickly demonstrate. So on the operating current asset side, add 9,000, 351,200, and 715,200. So your total should be $1,075,400. And then on the liability side, add 145,600 and 136,000. And again, your total there should be $281,600. So subtract this number from the asset side number, and your final answer should be $793,800, which is what's showing in the slide. So I think all of you got the right answer there. So all of you now know how to calculate this. My suggestion would be, to always keep the copy of the PowerPoint and make notes, because right now you may think it's easy to calculate, and then later on you may just be wondering, how did we calculate this? So make notes of what we are covering in class today. Okay, so this is the number that we calculated. Now we come to the third part, I guess. Let's see. So this is the third part, which is calculating the total net operating capital, which we have done. No, we have to do that. Okay, net operating capital, which is going to be here. Operating capital is equal to net operating working capital, which we just calculated, plus the net fixed asset. And from the previous slide, the net operating capital in 2010 was $1,317,842. So this number plus your net fixed assets, which are $939,790. And that is going to come from the balance sheet. And if I'm looking at the balance sheet, if you look at the net fixed asset on the balance sheet, it's $939,790. Okay, let me show you. There you go, this number here. So this is going to be added to that net operating working capital. So this plus this is $2,257,632. And similarly, you can also calculate for 2009. We know the net operating working capital number for 2009 is $793,800. So what's the net fixed asset number? Is $344 plus $344,800. Can you give me the total on calculator? $793,800 plus $344,800. And that's the answer we have here. Okay, everyone follow that? Yes. It's going to come from the from the asset side of the balance sheet. So, free cash flow, let's see what else needs to be done. So we have done this. So the free cash flow, I guess this skipped. So they have, this is step 4, net investing. They have net investment in operating capital that they have done in one step. So the free cash flow for 2010 is NOPAT minus net investment in operating capital. And NOPAT we had already calculated was $10,464 from our slide here. This is the one. And net investment in operating capital is $2,257,632, which we got here, minus from 2009, which was 1,138,600. So that is the number here, 1,119,032. So your free cash flow for the year is going to be negative $1,108,568. So how do you suppose the investors reacted to this? Not happy, because the free cash flows are negative. And the first impression the investors are going to have is probably there will be no dividend this year, or probably next year, if the company has incurred such a negative, such a huge negative net cash, free cash flow. So let's see the uses for free cash flow after tax interest payment. Now follow this. This is very important to understand. If you have notes, you must make these notes. How do you calculate after tax interest payment? So do you all see the interest expense here? For 2010, what's the interest expense? 176,000. But does the company pay, or the benefit to the company from that interest expense comes from what? What would be the net expense the company has to incur from this amount? Because remember, interest is taken as an expense, and that shelters the company from its tax. So that 40% of tax benefit that the company gets is actually a benefit to the company, right? So in a sense, the company is paying 176,000 less the benefit, realistically. So it's actually paying 60%. So how you calculate the use of free cash flow is after tax interest payment is going to be 176, and that's why I said, make note of that, because tomorrow you'll forget, multiplied with 1 minus the tax rate, which is 40%. So in a sense, this is 176,000 multiplied by 60%, or 0.6. And what's the answer? 176,000 multiplied with 0.6. That's equal to 105,600. And that's 105,600. Reduction or increase in debt. So let's look at again the balance sheet on liability side, and the company has increased debt where? At this point, and also notes payable. That is debt too, right? So this is going to be 720 and 1 million. And for 2009, this is 323,432. For long-term debt, and for notes, it's 200,000. So the total for 2010 is 1,720,000. Total for 2009 is 523,432. So the difference is 1,196,568. Again, students online, what I'm doing is looking at the total debt the company has increased or decreased in a year. So for 2010, total notes payable are 720,000 plus long-term debt of 1 million. So that's 1,720,000. And for 2009, it's 200,000 plus a long-term debt of 323,432, which is 523,432. So the increase from 2009 to 2010 is 1,196,568. Okay, everyone clear? And this is what is reported here. So why is it negative again? The number. Why is it negative? Basically it's not a use of free cash flow. It's actually increasing the free cash flow, so it's negative. That's why. Payment of dividend, that's money going out, so it's 11,000. That's a use of debt. Repurchase of stock, company didn't decide to pay, issue any stock, so it's 0. Purchase or sale of short-term investment, company decided to sell $28,600 worth of short-term investment, so this actually is money coming in. That's why it's negative 28,600. So total use of free cash flow is 1,108,568. Okay, everyone clear? All right, it's 7:33. Let's take a 10-minute break, and we'll resume at 7:45. Okay, and then we'll wrap up the chapter. Any questions at this point? No? All right, so I'm going to mute the mic for 10 minutes, and then. Okay, students online, can you all hear me? All right, let's continue. So return on invested capital, obviously investors do want to understand, what the return on invested capital would be, and this can be calculated by taking the net operating, the NOPAT divided by operating capital, and NOPAT for 2010, we've already calculated. Can go back and check. There you go, net operating profit after taxes. We got 10,464, and divided by operating capital, which we just calculate it here. This is 2257,632, which we just calculated here, operating capital. So this is 0.5%, and compare that with 2009, which was 11%. So NOPAT, again, if you're wondering how to calculate that, NOPAT for 2009 was the 125,460, and that would be divided by 1,138,600 for 2009, and that would be approximately 11%. So if the return on investment was 11% in 2009 and it dropped to 0.5% in 2010, again, shareholders won't be happy, because that severely limits the kind of return that they must be expecting on their investment. So the firm's cost of capital is 10%. This is an important question, so all of you please understand this. This is the weighted average cost of capital. Did the growth add value? At this instance, no. The answer is no, because the cost of capital is 10% and the return on investment is 0.5%. So it's actually a 9.5% negative growth or negative value. So the ROIC of 0.5% is less than the weighted average cost of capital of 10%. The investors did not get the return they require. And how would that reflect? If the investors did not get the return they require, where would this be reflected on? The share price. And again, answering a question about the discount factor increasing. So the return, the future cash flow. So 1 plus R raised to the power T. So this R would go up, because by having this low ROIC, investors feel that the future cash flows would be severely limited, so the risk to those future cash flows again go down. So they will increase the R factor to reduce the stock price of the company. The present value will go down. So note, high growth usually causes negative future cash flows due to investment in capital, but that's okay if ROIC is greater than weighted average cost of capital. For example, in 2008, Qualcomm had high growth, negative future cash flow, but a very high ROIC, just to give you an example. Okay, everyone clear? Students online? Let's look at the economic value added, EVA. Weighted average cost of capital is WACC. So EVA is equal to the net operating profit after taxes minus weighted average cost of capital multiplied with the capital. So this is going to be the cost of capital component, and this is going to be the net operating profit after taxes. If this is a positive number and if it's a high number, that would mean that economic value was indeed added to the company. In this case, NOPAT we've already discussed was 10,464. Weighted average cost of capital is 10%, which is 0.1, and the capital is 2257,632. So that means that is actually a negative economic value added. It's actually lost. The company lost 215,299 in terms of economic value. Compare that to 2009. Even though the weighted average cost of capital is the same, because NOPAT was high and the capital was low, So company had indeed added $11,600 in its economic value. So over this 1 year, company has lost 215,299 plus 11,600 in terms of economic value. Okay, everyone clear on that? No, it's given. So let's say, for example, the market rate of return is 10%. I mean, the interest cost is going to be 10% to you, or the weighted average cost of equity and debt is going to be 10% to the company. So let's look at another interesting aspect of valuation, which is coming from the market. So let's say that we are given this information that the stock price in 2009 is $8.50, in 2010 is $6. Number of shares didn't change, so it's 100,000. Earnings per share is 88 cents in 2009, and 2010 is negative 95 because of the loss the company made. Dividend per share, company share 22 cents in 2009 and 11 cents in 2010. First of all, looking at these numbers, what is the firm's total market capitalization? Dividends per share. What is the firm's total market capitalization? Or the market value of equity? Market capitalization I covered in the last class. It's going to be the number of shares multiplied with the stock price. So in 2010, it's $600,000. You also call it as the market value of equity, because that's what the market is placing as the value of the company. In 2009, it was $850,000. So over the year, the company lost $250,000 worth of market value. When you hear a news reporting saying that today the market lost $200 billion in its value, what does that mean? It means the market lost share value in total of 200 billion. Like what happened over the last couple of weeks. Everything clear, students online? So market value added would be market value of the firm minus book value of the firm. So where would the market value of firm come from? We just calculated, right? And where would the book value of firm come from? From the financial statements, the balance sheet and so forth. So market value is equal to number of shares of the stock multiplied by the price of share plus value of debt. And the book value is equal to total common equity plus the value of debt. So what we've added here is the value of debt. If the market value of debt is close to the book value of debt, then the market value is simply equal to the market value of equity minus the book value of equity, because it's a lengthy derivation, but simply think that the value of debt has been cancelled out from this equation. That's why, just cancel this out, because both sides you'll cancel out. That's why you simply have market value MVA equals market value of equity minus the book value of equity. Okay, so far so clear, students online? All right, so let's then move on to calculate a practical example here. So in 2010, market value added or the MVA, which assumes market value of debt equals to the book value of debt. Market value of equity is 100,000 multiplied by share price of each share, that's $6, and that's equal to $600,000. The book value of equity is 557,632. And where is this going to come from? From the liability side of the balance sheet. So let's go to the balance sheet, liabilities and equity. So there you go. 557,632. Students online, everybody clear on this? So let's go back. So this is going to be $600,000 less 557,632. That's equal to 42,368. That is the amount of market value added in 2010. Compare that to 2009. The market value of equity would be 100,000 shares multiplied by 850, which is going to be $850,000, minus the book value, book value of equity, which is again going to come from the balance sheet. And this is the book value of equity, 663,768. There you go. So it's 186,232. So the market value added is definitely low in 2010. By the way, looking at this formula, what is better for shareholders? A higher market value or higher book value? Exactly, a higher market value is better because that's creating the overall value for the company, because what you actually have invested, or what is actually is worth in physical assets, is being priced much higher in the market. So this is similar to, let's say for example, I have a car which on book value is $10,000 worth, but because of some special features or something in market, it is being valued at $15,000. Right? That's exactly what's happening here. The company, if you add all the physical assets of the company, it's worth $557,632. But in the market, it's selling for $600,000, which is good. So as a shareholder, higher the difference, better for you, because your invested wealth is valued much higher in the market. Pardon? Yes. Yes, so you can sell and get your return. But as a buyer, it's exactly the opposite. If you want to buy stocks of the company, you want to assess how far that difference is. You know, are you paying too much? You want it real close. And this was one of the, remember when we started this discussion, Warren Buffett, he had simple rules. When somebody asked him, how did you make all this money? He said, I never had any fancy, formulas, or I didn't use fancy calculators to calculate the valuation. I had these simple rules, and one of the rules was the book value versus the market value. He always looks for companies which are underpriced, which are bargains. He invested in Bank of America when Bank of America was priced at $2.10. He invested billions of dollars in that company, and he made several times over. With this simple rule, the book value was much higher than the market value. And over the years, he says this basic formula is the one that he looks for. The other thing that he says is, obviously, things sell for things sell cheap for a reason. Things in the market which sell cheap are generally of low quality, right? Then they probably are cheap for a reason. But if the management of the company is strong, if they know what they're doing, then they can turn the company around. So for example, in 1999, when Apple was almost close to bankruptcy, and Steve Jobs came in, and he knew what he wanted to do, and the management of the company was strong, it provided that value. So investors who would have invested money at that time would have made several times over. I remember in 2000, I think it was close to 2004. Yeah, that was his company. They fired him, and then they had to bring it back because, they almost lost the company. Around 2003, 2004, the company had a stock split. It was at around $80. They split it into two, so the stock came to 40. Imagine in 2004, investors who invested in the company at $40. The stock is close to what, $600, or it went to almost $650. Apple was the first company to touch the $1 trillion mark. Market value of $1 trillion. That's a huge amount. So these are simple rules which Warren Buffett says he has followed and he's made money. And this is to understand this simple principle is important. Why book value versus market value brings value to the shareholder. Let's look at some things on the tax code, corporate tax, and individual tax. Any questions on what we've covered so far? So we are moving now to the tax side of discussion. That could be a good topic for term paper, looking at how book value versus the market value can create overall value for shareholders, or does it hold? Does the simple formula hold, like Warren Buffett says? So let's look at, this is an old corporate tax rate, which is from 0 to 50,000. Rate on amount above the base is 15%. From 50 to 75,000, tax on base is 75. What that means is that this is the base. So up to 50,000, they anyway have to pay 7,500 plus 25,000 on any amount over 50,000. That's what it means. So this is how it works. So for example, if the tax liability is in 75,000 to 100,000 slab, up to 75,000 you pay 13,750, and above that amount, whatever amount it may be, you pay 34%. So let's say, for example, if a company's taxable income is 80,000, what would be the tax liability? It'll be 13,750 plus 34% of 5,000. And what is that amount? So it'll be 5,000 multiplied with 0.34. That's 1,700 plus 13,750. That's equal to 15,450. Okay, everyone clear on that? So up to 75,000, you have to pay 13,750, and since the company's income is 80,000, so for the 5,000, you pay 34%. All right. So the features of corporate taxation is progressive rate up until 18.3 million taxable income. Below 18.3 million, the marginal rate is not equal to the average rate. Why is the marginal rate not equal to the average rate? What is average? Average is total amount paid divided by, whatever the amount is, your total tax liability. And the marginal would be the amount of tax paid for each additional dollar that you earn. And why is that the case? Because look at the difference of slabs. So for example, if you earned $101,000, for that additional dollar, it'll jump to 39% and not 34. That's why marginal rate will be different from average rate. Above 18.3 million, the marginal rate and average rate are 35%. Why? Because look at this rate. 18.3 million and up, it doesn't make a difference. It'll be taxed at the rate of 35%. So companies have to pay this at minimum up to 18.3, and anything over would be taxed at 35%. A corporation can deduct its interest expense but not its dividend payments. Now, this is not standard, like I said, throughout the world. Different countries have different taxation laws, so some countries will allow dividend also as an expense. But in US, that's why it's called double taxation, because companies pay taxes and then investors who get dividend, they pay at personal tax rate. Corporation can carry back losses for 2 years, carry forward losses for 20 years. That is, they can take that as an expense. Exclude 70% of dividend income if it owns less than 20% of the company's stock. So if a company is invested in another company and owns less than 20% of the company's stock, it can exclude 70% of the dividend income and not have to pay tax there. And we have an example on that in slides to follow. Let's take an example here. Assume a corporation has $100,000 of taxable income from operations, $5,000 of interest income, and $10,000 of dividend income. Let's assume that it owns less than 20% of the company it's invested in. What would be its tax liability? So I'll give you a minute to try and calculate that. What would be the total tax liability here? First of all, tax liability. I'm sorry. What would be the taxable income? Total taxable income. Will $100,000 be taxed? Yes, right, because it's the company's income. What about interest income? Yes, because company has earned interest from its investment, so that would be added to its overall taxable income. The dividend income, remember we had the rule of 70% exclusion if the company owns less than 20% of the company. So what's 70% of $10,000? $7,000. So $7,000 can be excluded, right? What's left is $3,000. So the total taxable income would be $108,000. Okay. Everyone clear with that? What about tax rate? So let's go to the tax slab box. Let me clear this. So if it's $108,000, the base is what? 22,250. That's on $100,000, and above $100,000 is 8,000, and that's 39%. So what's 39% of 8,000? So it'll be 8,000 multiplied with 0.39. That's 3120. So 3120 plus 22,250. So that's equal to 25,370. Everyone clear? So let's go to our answer. This is the example. So there you go. So it'll be, this is the overall taxable income as we calculated, and this is the final tax bill that the company has to pay, 25,370. This is the base, and 39% of 8,000, which is over 100,000, totals to 25,370. So key features of individual taxation are individuals face progressive tax rates from 10% to 35%. The rate on long term, that is more than 1 year capital gain, is 15%. So if you are invested in stocks and you keep stocks for more than 1 year, then you pay 15% tax rate on any capital gains. Capital gains is if you bought something for less and then sold for high, the difference is taxed because it's your income. And that is going to be taxed at 15% because it's a capital gain. But capital gains are only taxed if you sell assets. So what is one feature in share investing that you can benefit from? You can defer your taxes. How do you do that? Not sell it. And another thing, what about dividends? How do you defer your, you reinvest your dividend. So how do you defer the dividend tax liability is to reinvest the dividend. That is, instead of taking cash out, you can ask the company to give you those many number of stocks which are equivalent to the dividend payout. So that is basically you are adding to your total number of stocks in the company. And that's why, sometimes when you watch movies where somebody bought like IBM shares in 1940s, and by end of 2000 now their grandkids are multi-millionaires because of those. I mean, that's reference is going to reinvestment of stocks going over and over again. Obviously the company would have to be very successful to do that. I mean, IBM was immensely successful company that increased shareholder value a lot. Interest on municipal, that is state and local government bond, is not subject to federal tax. So that's another interesting feature about municipal bonds. It may be subject to some state tax, but no federal tax. Taxable versus tax-exempt bonds. State and local government bonds, munis or municipal bonds, are generally exempt from federal tax. Let's take an example here. You have an Exxon Mobil bond at 10% coupon payment versus California Muni bond at 7%. So which would be a better investment? Well, let's calculate. Let's assume that your tax rate is 25%. After tax interest income would be, in case of Exxon, let's say that you have $5,000 invested in this bond. So 10% of 5,000 less 10% of 5,000 multiplied by 0.25, which is your tax liability, because you are in 25% tax bracket. So any income you make on the coupon payout on this bond is going to be taxed at 25%. So this is going to be $500, your coupon payout. You'll be taxed at 25% on this payout of $500, and that is $375, which is going to be your after-tax payment. You can do it several ways, but let's say 500 into 0.25, that's 125. So 500 minus 125, because $125 will be your tax. So after tax, you will receive $375. In the California municipal bond, because there is no federal tax, all you do is just calculate your return, which is going to be 7% of 5,000, and that's $350. So which would be a better investment? Obviously, ExxonMobil has a $375 return versus $350 of California muni bond. So you may want to go with California muni bond based on return, but based on risk, risk return, which is a safer investment in this example? The muni, right? I mean, it's supposed to be a safer investment because corporate bonds are more risky than municipal bond, even though now that myth has been broken, because we have several muni bond defaults. We had the case of city of Detroit and also some other cities which have defaulted on their bond repayment. So that myth has been broken. Earlier it was assumed that muni bonds are safe investment, but purely based on return, Exxon plays well, $25 more. But the idea is that even though on paper it says 10% return, so you may think $500 is something you'll get as your net, you still have to pay tax, and your net is going to be $375. So what's going to be the break-even tax rate? That is, if the tax rate, at what tax rate would you be indifferent between muni bond and corporate bond? And to solve that, you can use the simple formula, which is muni yield is equal to corp yield multiplied by 1 minus the tax rate. In this case, it's going to be 7% equals 10% multiplied by 1 minus t, and solving for it, it's going to be 30%. You can do it like this. It'll be 7% equals 10% minus 10t. So this is 10, 7. So this is going to be equal to, you take it on the other side, and this is going to be 7 minus 10, and that's equal to minus 3, equals to 10 minus 10t, and then t equals minus 3 divided by minus 10. So negative cancels to negative, and 3 is simply going to be 0.03. 0.03. So that's equal to 30% here. Yeah. So that yes. So that would be the indifferent point. That is, if your tax rate would be 30% instead of 25%, then you would be indifferent, and you can check with it. For example, if you had 30% instead of 25%, you would have $500 as your return and pay 30% tax. So it's going to be 500 multiplied by 0.3, that's equal to 150. and that will be 350. And in this case, since you're not paying any federal tax, it will be 350. So 350 will be equal to 350. So that would be the tax rate. If you are placed in that tax rate, you'll be indifferent between investing in municipal bond or corporate bond. So obviously, municipal bond is going to be better for high income individuals who are going to pay a higher tax rate. So to shelter that tax payment, you can invest in municipal bonds. So implications: if T is greater than 30%, like we had discussed, buy tax-exempt munis. If T is less than 30%, buy corporate bonds. Only high income and hence high tax bracket individuals should buy munis. And that brings us to end of chapter 2. Are there any questions at this point? Okay. If there are no questions at this point, then that's all for the class this evening. Please proceed to work on the assignment, which I'll be posting by tomorrow morning, and that'll be available under the assignments tab. There'll also be a discussion post assignment, and I hope all of you are working on your case studies and have been thinking about a term paper proposal. All right. Well, we are almost coming to the end of the time anyway. If there are any questions, are there any questions at this point? No? All right, then. That's all for the class this evening. Thank you for joining. And I'm signing off from the Natchez campus, and I'll see you next week. Good night. Bye-bye.